Welcome back. It's JWalter here, and here's your latest housing market update, and hope you're having an awesome day. In today's video, I'm going to be sharing the latest stats regarding mortgage delinquency rates and foreclosures. I'm also going to be sharing some news regarding lenders laying off their employees as well, because there's a lot of reports in the news right now regarding that. So I'm going to be sharing the latest stats with you guys. Also, I'm getting a lot of comments as well saying that there's going to be a housing market crash this year or next year. So I'm going to be sharing some insights regarding that as well. So I hope you guys get a lot of value out of today's video. If you do, please hit the like button. I greatly appreciate that. Also, if you're looking for a real estate agent referral in your neck of the woods, check out that link below, which is homeandmoney.com/Jason to get connected with a great real estate agent in your neck of the woods. So with that said, let's begin today's video. This is according to Black Knight. If you're not familiar with Black Knight, they are a data analytics firm that support the mortgage and real estate market, or industries, I should say. In any case, this is our latest report for March 2022. They report on a monthly basis what's really going on with mortgage delinquency rates and also foreclosures as well, so we can get an indication about where housing market is headed, right? So in any case, they report that the national delinquency rate dropped by more than 0.5 percentage point in March, falling to 2.84% and shattering the previous record low of 3.22% in January 2022. So taking a step back, approximately 3% of all U.S. mortgages are delinquent right now, so a very low share, in fact, a record low share for people who are behind on their mortgage payments. It also says here that delinquencies have been falling by 10% on average over the past 20 years. However, the last year, the reduction in the people who are late on their mortgages has been reduced by 15.5%, and they're saying that's exceptionally strong, well above the average over the past 20 years, a decrease of 10% on average. Now we have a decrease of 15.5%. Now in this report, it's not all good news. I'm going to be absolutely transparent with you guys and share all the information with you guys. I'm also going to be sharing the states that have the highest shares of people who are late on their mortgages, and also the states have the lowest shares of mortgage delinquencies as well, because there's some pretty big differences there as well. So it says here, the robust employment, continued student loan deferrals, strong post-forbearance performance, and millions of refinances into record low mortgage rates have all helped put downward pressure on delinquency rates. So of course, because we have people who have entered into a forbearance where they don't have to pay their mortgages for 12 to 18 months, when they're exiting forbearances, we're starting to see those people who have exited, they are remain current on their mortgages in big numbers here. Also, we're seeing the share of people who have done refis. Like myself, I have a 30-year fixed rate mortgage at 2.6%. Therefore, my housing payment went down. Millions of people did that this past couple of years, and they have record low mortgage rates. And of course, their housing payment went down as well. And that further causes downward pressure on delinquency rates. In addition, because millions of people refied into record low mortgage rates, on a side note, this has caused our active housing inventory, or the total number of houses for sale in the US, to be at very low levels here. So the latest stats we have from Redfin, we have right now, as of the 17th of April, we have just under 500,000 houses for sale in the US. Compare that to 2019, we had over 1 million. So we basically have half as many houses for sale compared to pre-COVID. This is one reason, in my personal opinion, why we're not going to be seeing a housing market crash anytime soon, because if we have near record low housing inventory, how can we have a housing market crash when there's barely any houses on the market? In my personal opinion, we have to have millions of houses to hit the market in order to have a big decrease in home prices. So that's my personal takeaway, but comment below with what you guys think regarding that. Here's something I want to bring to your attention though, and this is a mixed news. It's some good news and also some bad news for our housing market here. So it says, those serious delinquencies, which are defined by 90 days or more past due, those actually fell 12% for the strongest single month improvement in 20 years. So a big improvement compared to 1 month ago. However, they remain 70% above pre-pandemic levels. So we're starting to see the number of serious delinquencies increase compared to pre-pandemic levels, a big increase of 70%. And I'll definitely keep you posted regarding that, because does that mean we're going to be seeing more foreclosures in the future? Time will tell. But right now, though, the number of foreclosure starts actually fell by 3% compared to the prior month, and we're also holding well below pre-pandemic levels. So we're not seeing the foreclosures hit the market, and we're still below the levels we saw in 2019 and in years past as well. In addition, the number of active foreclosures actually increased slightly in March, marking the first year-over-year increase in almost 10 years, though inventories also remain well below pre-pandemic levels. So as you guys all know, the CARES Act was passed in March 2020. In that act, they had a foreclosure moratorium where basically lenders could not foreclose on people who are late on their mortgages. And that moratorium lasted for well over a year. So I'm not surprised, at least on a year-over-year basis, we're starting to see an increase compared to last year because, of course, we had these moratoriums in place 1 year ago. So one part of this graphic here that I wanted to bring to your attention is the number of properties that are 90 or more days past due. So these are serious delinquencies, 90 or more days past due, but not yet in foreclosure. So as of March 2022, there were 694,000. That's a decrease of 93,000 compared to the prior month in February 2022. And look at this, compared to 1 year ago, a decrease of 1.2 million mortgages that are not seriously delinquent. And also you can see this trend here. So the anything in red here is basically a red flag, a big number here. But the trend over the past 12 months has been on a declining trend. As you can see here, 1 year ago, it was at very high levels, but has been decreasing ever since March of this year, only at 694,000 compared to over 1.7 million from 1 year ago. Okay, let me share the latest stats with you guys at the state level. So here are the top 5 states by non-current percentages. In other words, here are the top 5 states. They have the highest shares of mortgages that are not current. So Mississippi led the pack at 6.21%, followed by Louisiana, Oklahoma, Alabama, and West Virginia at 4.4%. So again, low numbers, but these are the highest in the US right now. Important to note here, take a look at this, because in Mississippi, again, 6.21%. That's a 30% decrease compared to 1 year ago. But look at the peak here. I really like how they shared this, because at the peak, which is in October 2005, in Mississippi, during October 2005, 23.24% were not current on their mortgages. A big increase compared to the low that was set in March 2020 at 5.56%. So in other words, we're not too far off in Mississippi from the all-time record low of 5.5%, because right now it's 6.2%. Also, have a look at Louisiana. So right now, 5.81%, a 30% decrease compared to a year ago. But look at the peak. Also in October 2005, the peak of delinquent mortgages was actually at 30%. So 30%. So basically 3 out of every 10 mortgages in October 2005 in Louisiana were actually delinquent on their mortgages. Pretty remarkable there. However, what's different in Louisiana, Oklahoma, Alabama, and West Virginia compared to Mississippi is that the all-time record lows were actually set last month for the lowest share of delinquencies in any other month on history here, according to Black Knight here. So the lowest share were actually set in March 2022 for those 4 states, even though they are at the top 5 states, they had the highest share of non-current mortgages. In stark contrast, here are the states that had the lowest share of delinquent mortgages in the US. Utah led the pack at 1.98%, followed by California, Colorado, Idaho, and Washington. And of course, these are the states that had the highest gains in home price appreciation compared to these other states here as well. So of course, it makes sense that we're seeing a lower share of delinquent mortgages in these states compared to these other states here that had a higher share. What is also interesting to note here is that in Utah, the share is at 1.98%. That's actually the all-time record low that was set in March. Also in Idaho at 1.71%, that's also an all-time low as well. What I also found to be intriguing here in this report here is that in California, the peak of non-current mortgages in California was actually in February 2010, and that was at 15.65%. I mean, that's a big difference compared to Louisiana at a peak of 30%, Mississippi at a peak of 23%. So a big difference when you look at California versus Mississippi and Louisiana for their peak of non-current mortgages. Also in California, we have a decrease of 51% compared to 1 year ago of non-current mortgages as well. Utah, a decrease of 37%. Colorado, a decrease of 43% compared to 1 year ago. So obviously we had a higher share of non-current mortgages compared to 1 year ago for many of these states here. Okay, so changing gears slightly, let's talk about the top 5 states by 90 days or more delinquent. So the top 5 states that had the highest share of serious delinquencies for mortgages. So Mississippi again led the pack, also followed by Louisiana, Alabama, Arkansas, and Maryland. But Mississippi right now, the share of mortgages that are seriously delinquent, meaning 90 days or more past due, is at 2.7%. But look at 1 year ago. That's a decrease of 53% compared to 1 year ago. Also, look at the peak. The peak was actually in December 2005 when we had 10% of all mortgages in Mississippi that were 90 days or more past due. Now it's only 2.7%. So obviously a far less share of seriously delinquent mortgages compared to the peak in all these states here. Also in Louisiana, the share was at 2.7% compared to the peak in December 2005, it was 13%. So basically March 2022 compared to December 2005, we basically had 10 times more serious delinquent mortgages in Louisiana. Black Knight also records the states that had the highest rates of improvement over the past 6 months, and also the states that had the biggest declines over the past 6 months as well, or the biggest increases over the past 6 months, I should say. So in Hawaii, that actually led the pack with the biggest 6-month improvement in non-current mortgages right now. The improvement was actually a decrease of 40% compared to 1 year ago. Louisiana, even though they're at the top of the states that had the biggest share of non-current mortgages, they actually had the second highest 6-month improvement at 35%, followed by Nevada, California, and New Jersey. In contrast, though, the top 5 states that had the least improvements regarding non-current mortgages, meaning they have a smaller decrease in the number of non-current mortgages, leading the pack was actually in Michigan, only a 10.67% decrease compared to North Dakota, Iowa, Maine, and New Hampshire. New Hampshire, a decrease of 17%. So in stark contrast, Hawaii had a decrease of 40%, basically at 4 times less than Michigan, for example, at least for percentages. Okay, so changing gears, I want to talk about a lot of reports right now regarding lenders laying off their employees right now. So Wells Fargo actually announced they're going to be cutting mortgage jobs. Actually see this here on housingwire.com. Wells Fargo cuts mortgage jobs amid poor outlook. So let's talk about that, because some people, like I'm getting a lot of comments regarding this, that because lenders are laying off their employees, it means they are forecasting for a housing market crash. However, that's really not the picture here. So have a look at this. This is according to nationalmortgageprofessional.com. Wells Fargo confirms mortgage-related job eliminations. But the question is, take a step back. Why are lenders firing employees, right? One key reason, of course, is because a lack of refinancing activity. Because mortgage rates have increased approximately 2 percentage points in the matter of just this year alone, this is causing the amount of people submitting applications and also doing refis to fall off the map, basically. And because of this, the bank reported a first quarter drop in net income, and that was the largest it had seen since 2003, largely driven by lower refinancing activity. If you follow the channel, you know where I'm going with this, but the Mortgage Bankers Association, they announce mortgage purchase applications and also refis, or mortgage applications as a whole here, but they actually break it down by the total number of people submitting loan applications for refis and also purchases. So have a look at this. This is the most recent stats we have from the Mortgage Bankers Association. Here's the refi index. It has decreased 68% compared to 1 year ago. So in other words, their index has decreased by a very, very large amount, because we're seeing a lack of people refiing, because why would you refi if you have a 3% mortgage when mortgage rates right now are approximately 5.5%? So one reason why we're seeing lenders laying off their employees is because they're not seeing enough refis coming through, and therefore it's hurting their income, as you can see right here. So it says Wells Fargo has confirmed that on Friday, which was last week, it eliminated jobs related to its mortgage lending business just 8 days after the bank reported the largest quarterly drop in net income in nearly a decade. In a brief email statement from Wells Fargo, they said displacements last week, which are layoffs, were the result of cyclical changes in the broader home lending environment. Obviously, we're seeing a reduction in purchase applications as well. So this could not be just because of refis or the lack of refis. It could be, of course, due to the lack of, or the decrease in the amount of people submitting applications for home purchases as well, because mortgage rates have been increasing greatly as well. It also says here, Wells Fargo, the 4th largest U.S. bank by assets, on April 14th reported first quarter 2022 net income of $3.7 billion. That's actually down 20.8% compared to the same quarter 1 year ago. And Wells Fargo's CEO had this to say: higher mortgage rates had negatively affected the bank's mortgage origination business. He described it as one of the largest declines I can remember. Meanwhile, Better.com also announced a third round of layoffs in the past 4 months. Also, FinTech Blend Labs eliminated 200 positions, or about 10% of its workforce. Both companies cited rising rates and reduced refis as reasons for the cuts. So in other words, lenders are being impacted negatively because of lack of people submitting refi applications. However, they're also being impacted by the decrease in mortgage applications for home purchases as well. Because according to the Mortgage Bankers Association, that has decreased by 14% compared to the same week 1 year ago, a decrease in the number of people submitting loan applications for home purchases. So comment below with your biggest takeaways from today's video. Also check out that link below if you want a real estate agent referral in your neck of the woods. Hope you have an awesome day and look forward to seeing you on the next video.